Morning everyone, welcome to Ainsley News. End of the week, and what a week it has been. Anyone keeping an eye on the markets has enjoyed a tumultuous ride. Today we're preparing for impact as PPI surges. Never a dull night on global markets. Last night was again a sea of red. The only green was yet again the US dollar at near 20-year highs, and a big cap crypto coming off massive falls. The S&P 500 rallied a little late to avoid falling into an official bear market by just 2 BPS, and the Nasdaq long left the bear market station down 32%, and now its biggest fall since the GFC. Gold and silver broke their hold and both fell sharply on the night, possibly due to liquidations to pay up margin calls on shares. With bond yields plummeting and inflation raging, that of course makes no sense for precious metals that love a negative real interest rate and market turmoil. However, in a market where the other big liquid market of crypto has fallen so sharply, gold stands prominently as a beautiful liquid market that has held strong relative to the carnage around it. Margin call money has to come from somewhere. The night was notable for a strong indicator that inflation isn't going anywhere soon, with the US factory door PPI print coming in higher than expected at an eye-watering 11%, up another 0.5% in just 1 month. That's amazing. The following meme puts the situation into clear perspective. There's a lovely meme here showing someone cleaning up the beach, interest rates at 1%, 11% PPI inflation coming through as a tidal wave on top of that. Yesterday we spoke to the 8.3 CPI print, and those with an even rudimentary appreciation of math will see the problem there. A few charts we're showing you here today. When prices are going up 8.3% and input costs for those goods are up 11.3%, that either means prices go up more or the companies producing them have reduced margins. Margins equal earnings, and earnings in a normal world are how shares are valued. For 16 straight months now, that's been the case. Valuations, even after this rout, are historically high, so there is plenty of scope for further falls. And hence the question on everyone's lips and the scrutiny of every word from the Fed's mouthpieces is how committed they are to keep hiking rates, when just a mere 0.75% rate rise has crashed the market. Last night at the end of the market's day, the head honcho himself, US Fed Chair Powell, gave some insight into this in an interview with Marketplace Radio, where he admitted a soft landing is something they don't control. Here are some excerpts from that are well worth listening to. This is them. But what would I say to that person? So I would say that we fully understand and appreciate how painful inflation is, and that we have the tools and the resolve to get it down to 2%, and that we're going to do that. I'll also say that the process of getting inflation down to 2% will also include some pain, but ultimately the most painful thing would be if we were to fail to deal with it and inflation were to get entrenched in the economy at high levels, and we know what that's like. And that's just people losing the value of their paycheck to high inflation, and ultimately we'd have to go through a much deeper downturn, and so we really need to avoid that. And whilst they've tried to calm the market with assurances of 70 BPS hike is off the table, Powell again, if things come in better than expected, then we're prepared to do less. If they come in worse than we expect, then we're prepared to do more. This is from the interviewer. Let me be clear, 75 basis points is prepared to do more. From Powell, what you've seen this community adapt to the incoming data and the evolving outlook, and that's what we'll continue to do. All for all, the Fed's got this. Proponents, like all previous corrections since the GFC, has seen the Fed coming to the rescue. There are huge events, geopolitical events going on around the world that are going to play a very important role in the economy in the year or so. So the question whether we can execute a soft landing or not may actually depend on factors that we don't control. And so the well-worn playbook of raising rates till something breaks and then quickly reverse to save the day may well be tested further this time. Just remember that there are multiple factors at play though. Whilst the Fed may not lower their Fed funds rate or rotate from QT or quantitative tightening back to quantitative easing, the market can and has taken yields into their own hands. And the analogy of the dam wall starting to fail and the Fed's various fingers in various holes looms large. In 2018, we saw, but many did not fully appreciate, the repo crisis playing out behind the scenes of just rates and QE. There is an unprecedented body of debt behind that dam wall, facing surging inflationary pressures. The Fed has only so many fingers. in an incredibly complex matrix of global financial markets, currencies, derivatives, debt instruments, demographics, and disruptive change. Always remember Exeter's pyramid and protect your wealth. And that's news for this week, everyone. We hope you've enjoyed. The news is always entertaining, but the markets are just as entertaining this week. Jump over to ainsleyBullion.com.au if you are looking to purchase the physical stuff, ainsleywealth.com.au if you're looking to buy that dip. Pretty attractive right now. Could be a great time to grab some Bitcoin or any of our large cap cryptocurrencies. Or if you're into crypto already, if you haven't checked out the gold silver standard, check it out because it's a great place to park profits and move between other cryptocurrencies in times of volatility in the crypto market. Pretty clever there. You can actually do that through CoinSpot or you can do it through Ainsley Wealth itself. Enjoy your weekend, everyone. We'll catch you next week for more news.